The machine, a new era of trading. Picture this, folks. It's Tuesday morning. The market opens, and your favorite stock, let's call it Acme Rockets, starts to dip. Your stomach churns. Your palms get sweaty. You remember your Uncle Bob telling you at Thanksgiving that Acme is a sure thing. But the numbers on the screen are screaming red. What do? Do you panic sell? Do you double down out of sheer hope? This, my friends, is emotional trading. It's a roller coaster of gut feelings, fear, and greed. It's a recipe for disaster, and it will chew you up and spit you out faster than you can say margin call. It's the old way of doing things, and it's a tough way to make a buck. Now let's flip the script. Imagine a different approach. Instead of gut feelings, you have cold, hard data. Instead of panic, you have a pre-programmed plan. This is the world of quantitative trading, or as the big shots on Wall Street call it, quant trading. Think of it as trading with a super brain. It doesn't get scared. It doesn't get greedy. It doesn't care about Uncle Bob's hot tips. All it cares about are numbers, patterns, and probabilities. It's about using the awesome power of computers and mathematics to make smarter, faster, and more disciplined trading decisions. This isn't science fiction, people. This is happening right now, and it's changing the game forever. The core difference is simple. Logic over emotion. A human trader might see a stock plummet and think, it's all over, sell, sell, sell. A quantitative model, on the other hand, might analyze the speed of the drop, the volume of shares being sold, and historical data from the last 10 times this happened. It might conclude that this is a classic overreaction and that the price is 85% likely to rebound within the next hour. The quant system then executes a buy order automatically, without a second of hesitation. It's about replacing I feel with the data shows. It's a seismic shift in how we approach the markets. So, why does this matter to you? Because the market is a battlefield, and you don't want to bring a butter knife to a gunfight. The big institutional players, the hedge funds, the investment banks, they aren't relying on hunches. They have armies of PhDs, mathematicians, and computer scientists building these sophisticated quant systems. They are leveraging technology to gain an edge, to compete, or even just to understand the forces moving the market. You need to understand their playbook. This is your introduction to that playbook. Booyah! Let's get you in the game! Alright, listen up. If quantitative trading is a high-performance race car, then data is its high-octane fuel. You can have the most powerful engine in the world, but without fuel, you're going nowhere. In trading, data isn't just important, it's everything. We're talking about every single price tick, every trade volume, every earnings report, every interest rate decision from the Federal Reserve. It's a gigantic ocean of information, and hidden within it are the clues to where the market is headed next. The goal of a quant is to be the best deep-sea diver, finding the treasure chests of profit buried on the ocean floor of data. In the old days, traders looked at stock tickers and maybe read the Wall Street Journal. That was their data. Today, we're in the age of big data. This isn't your grandfather's filing cabinet of information. We're talking about petabytes of data. That's millions of gigabytes. This includes traditional market data, like stock prices going back decades, but it also includes so much more. Think about satellite images of oil tankers to predict supply, credit card transaction data to forecast retail sales, or even the sentiment of millions of social media posts to gauge public opinion on a company. It's a fire hose of information, and you need the right tools to drink from it. So why is more data better? Think of it like being a detective. If you have one witness to a crime, you have one perspective. If you have 100 witnesses, plus security camera footage and forensic evidence, you can piece together a much more accurate picture of what really happened. In trading, having more data points helps you filter out the noise from the signal. A single data point might be a fluke, but a pattern that repeats itself over millions of data points is a trend you can bet on. Big data allows quant models to find subtle, complex relationships that no human could ever spot. This is where the real edge comes from. A human can track maybe a dozen stocks closely. A computer can track thousands of stocks, Forex pairs, and commodities simultaneously in real time, 24/7. It can analyze decades of historical data in the blink of an eye to find out what happened the last 50 times a specific economic indicator was released. This massive scale and depth of analysis are impossible for a human brain to replicate. That's why the quants who can harness this data effectively are the new kings of Wall Street. They're not just guessing, they're making calculated bets based on an overwhelming amount of evidence. So, you've got this mountain of data. Now what? You can't just stare at it and hope it tells you its secrets. You need the right tools to dig in and start prospecting for gold. For modern quants, the top tools in the shed are programming languages, specifically Python and R. Think of these languages as the shovels and pickaxes of the digital gold rush. They allow you to sift, sort, analyze, and visualize massive datasets with incredible speed and efficiency. You don't need to be a level 10 code wizard, but you need to understand what these tools can do. They are the engine of quantitative analysis. Python has become the fan favorite on Wall Street, and for good reason. It's relatively easy to learn, it's powerful, and it has an incredible ecosystem of free libraries built specifically for data analysis and finance. Libraries like Pandas are perfect for manipulating financial time series data. NumPy is a powerhouse for mathematical calculations, and scikit-learn gives you access to machine learning models right out of the box. R is another heavy hitter, especially in academia and statistical analysis. It's a fantastic tool for rigorous statistical modeling and creating high-quality data visualizations. The bottom line is, these languages are the bridge between a raw idea and a testable trading strategy. But what are you actually with these tools? You're applying mathematical models to find profitable patterns. One of the simplest yet most powerful models is linear regression. Don't let the name scare you. All it means is drawing the best-fitting straight line through a bunch of data points. For example, you could plot a company's advertising spending against its sales revenue. If the line goes up, you found a positive relationship. In trading, you might use it to see if there's a relationship between the price of oil and the stock price of an airline. It's a basic but fundamental way to quantify relationships between different variables. Then you have more advanced techniques, like Monte Carlo simulations. This sounds fancy, but the idea is simple. It's about playing a game of what if thousands of times to understand the range of possible outcomes. Imagine you have a trading strategy. You can use a Monte Carlo simulation to test how it would perform under thousands of different, randomly generated market scenarios. This helps you understand the worst-case scenario and the potential risk of your strategy. It's like a digital crystal ball that shows you not one future, but thousands of possible futures, allowing you to prepare for anything the market throws at you. These mathematical tools are what separate professional quants from amateur gamblers. Let's get down to brass tacks. You've analyzed the data, you've built your mathematical model, and you've found a potentially profitable pattern. Now it's time to put your money where your math is. This is where trading algorithms come in. An algorithm is just a set of rules, a recipe, that a computer follows to perform a task. In this case, the task is executing trades. Think of it as creating a little robot soldier that will follow your orders perfectly, without emotion or hesitation, 24 hours a day. You build an army of these robots, and they go to war for you in the markets. These algorithms are the workhorses of quantitative trading. They connect directly to the market exchanges and can execute orders in fractions of a second, faster than you can blink. The instructions you give them can be simple or incredibly complex. A simple algorithm might be, if stock X crosses above its 50-day moving average, buy 100 shares. If it drops below, sell. This is a classic statistical or rules-based algorithm. It's based on predefined statistical conditions. The computer just monitors the market and pulls the trigger when the conditions are met. No drama, no second guessing. Just pure, disciplined execution. But now, we're seeing the rise of a new breed of algorithm powered by artificial intelligence. These aren't just following a static set of rules. AI-based algorithms can learn and adapt. They are designed to analyze vast amounts of data in real time and identify patterns that weren't explicitly programmed in. For example, an AI algorithm might analyze the relationship between dozens of variables, market volatility, news sentiment, trading volume, and more, and decide on its own that a unique combination of these factors presents a buying opportunity. It's like having a master trader who gets smarter and more experienced with every trade. The difference is crucial. A statistical algorithm is like a soldier who follows a specific command. Take that hill. An AI algorithm is like a special forces operator who is given a mission. Secure the area. It has the autonomy to assess the situation and choose the best tactics to achieve the goal. This adaptability makes AI-based algorithms incredibly powerful in today's fast-changing markets. They can react to new information and evolving market dynamics in ways that a rigid, rules-based system simply can't. This is the cutting edge, and it's where the big money is being made. Let's talk about the real game changer, the technology that's turning Wall Street on its head: artificial intelligence. AI, and specifically a subset of it called machine learning, is the rocket fuel for modern quantitative trading. If basic quant analysis is like using a calculator, AI is like having a team of Einsteins working for you around the clock. AI's specialty is finding needles in haystacks. In the financial markets, the haystack is the near infinite amount of data, and the needles are the profitable trading opportunities. Humans can't process this much information, but an AI can. So what does AI actually do? Well, one of its biggest jobs is pattern recognition on a massive scale. An AI model can scan through decades of price charts, economic reports, and news articles for thousands of different assets simultaneously. It can identify incredibly subtle and complex patterns that a human would never see. For instance, it might discover that a certain combination of rising oil prices, a strengthening Japanese yen, and negative social media sentiment about a specific tech sector has preceded a market dip by 36 hours with 78% accuracy. This isn't a simple rule, it's a multidimensional pattern discovered by the machine itself. Another powerful application of AI is in analyzing unstructured data. This is information that doesn't fit neatly into a spreadsheet, like news articles, corporate filings, or tweets. Natural language processing, or NLP, a branch of AI, allows computers to read and understand human language. An AI can scan thousands of news sources and social media feeds in real time to gauge market sentiment. Is the tone of the news about Apple becoming more positive or negative? The AI can quantify that sentiment and turn it into a tradable signal. It's kind of like having the ability to read the mind of the entire market at once. Ultimately, AI in trading is about making predictions. Machine learning models, such as neural networks, are trained on historical data. They learn the relationships between inputs, like market data, and news, and outputs, like future price movements. Once trained, the model can be fed new, live data, and it will generate a prediction about where the price is likely to go next. This doesn't mean it's a perfect crystal ball. There are no guarantees in this business. But it provides a statistical edge, a higher probability of being right. And in a game of inches like trading, a small edge can lead to massive profits over time. Alright, so you have the tools and the tech. But, a toolbox is useless without a blueprint. In the quant world, that blueprint is your trading strategy. There isn't just one magic formula. Quants use a wide variety of strategies designed to make money in different market conditions. These aren't wild guesses. They are systematic, data-driven approaches to capturing market inefficiencies. Understanding these core strategies helps you understand how the smart money is moving, so listen up. This is where the rubber meets the road. One of the most popular strategies is trend following. The idea is as old as the markets themselves. The trend is your friend. A trend-following algorithm identifies an asset that is moving consistently in one direction, up or down, and jumps on board for the ride. The algorithm uses statistical indicators like moving averages to define what constitutes a trend. When the price moves above a certain long-term average, the algorithm buys. It holds the position as long as the trend continues and sells when the trend shows signs of reversing. It's a simple, powerful strategy for capturing big market moves. Another key strategy is mean reversion. This is the opposite of trend following. It's based on the idea that prices, like a rubber band, can only stretch so far from their average before they snap back. A mean reversion strategy looks for assets that have experienced extreme price moves, either way up or way down, and bets that they will revert to their historical average. For example, if a stable blue chip stock suddenly drops 15% on no real news, a mean reversion algorithm might automatically buy it, betting on a quick bounce back to its normal price range. It's a strategy that thrives on market overreactions. Finally, you have more complex strategies like statistical arbitrage, or stat arb. This involves finding two stocks that historically move together. Think of Ford and General Motors. Their stock prices usually trend in the same direction. A stat arb algorithm monitors the prices of thousands of these pairs. If one stock, say Ford, suddenly shoots up while its correlated partner GM stays flat, the algorithm will simultaneously sell Ford and buy GM. It's betting that the historical relationship will reassert itself, and the price gap between them will close, guaranteeing a small, low-risk profit. By doing this thousands of times a day, those small profits add up to big money. I'm gonna say this once, so listen carefully. I don't care how brilliant your strategy is. I don't care if you have a quantum computer powered by lightning. If you don't manage your risk, you will be blown out of the water. Period. End of story. The market is a wild beast and it can turn on you in a heartbeat. The number one job of any trader, and especially a quant trader, is not making money. It's not losing money. Risk management is the seatbelt, the airbag, and the roll cage of your trading vehicle. It's what keeps you in the game long enough to be profitable. Professional quants are obsessed with risk. They build risk management directly into their algorithms. One of the most basic and essential tools is the stop loss. It's an automatic sell order that gets triggered if a position falls by a predetermined percentage or dollar amount. If your algorithm buys a stock at $100 and you set a 5% stop loss, the system will automatically sell it if it drops to $95. This puts a hard floor on your potential loss. It takes the emotion out of the decision to cut a loser. The machine does it for you. No questions asked. This discipline is what separates the pros from the amateurs who ride their losers all the way to zero. But quants go much deeper. They use sophisticated statistical measures to understand their total portfolio risk. One of the industry standards is called value at risk, or VAR. Don't get bogged down in the math. Here's what it means. VAR answers the question, what is the most I can expect to lose over a certain period with a certain level of confidence? For example, a VAR calculation might tell a hedge fund manager, with 99% confidence, your portfolio will not lose more than $5 million tomorrow. This allows them to quantify their risk exposure and make sure they're not betting the whole farm on any single day. Another key component is position sizing. This is all about how much capital you allocate to any single trade. A common mistake is to put too much money into one high-conviction idea. Quants do the opposite. They typically allocate a very small percentage of their total capital, often less than 1%, to each trade. This way, if one trade goes horribly wrong, and some will, it's just a small cut. It doesn't blow up the entire portfolio. By making many small, calculated bets, they ensure that no single event can knock them out of the game. It's about surviving to trade another day, because that's the only way you can win in the long run. Let me ask you something. Would you buy a car without test driving it first? Would you fly in an airplane that had never been tested in a wind tunnel? Of course not. That would be insane. So why on earth would you risk your hard-earned money on a trading strategy that you haven't thoroughly tested? This is where backtesting comes in, and it is an absolutely non-negotiable step in the quantitative trading process. Backtesting is the practice of simulating your trading strategy on historical market data to see how it would have performed in the past. It's your flight simulator for the financial markets. The process is straightforward. You take your algorithm, your set of buy and sell rules, and you unleash it on years, or even decades, of past data. For instance, you could test your trend-following strategy on the S&P 500 from 1990 to 2020. The backtesting software will go through the data day by day, executing trades according to your rules and generating a report on the hypothetical performance. It will tell you how much profit or loss you would have made, the maximum drawdown, the biggest peak-to-trough loss, and dozens of other key metrics. It's a report card for your strategy. This process is invaluable for several reasons. First, it tells you if your brilliant idea actually has any merit. An idea that sounds great in your head might turn out to be a total dud when confronted with real historical data. Backtesting helps you fail fast and fail cheap, on paper, before you lose any real money. Second, it helps you refine and optimize your strategy. Maybe your backtest shows that your stop loss is too tight and gets you kicked out of good trades too early. You can adjust the parameter and run the test again, iterating until you find the optimal settings for your system. But a word of warning, folks. Backtesting is a powerful tool, but it's not a crystal ball. A common pitfall is overfitting, where you tweak your strategy so much that it perfectly fits the historical data, but fails miserably in live trading because it's too tailored to the past. That's why quants also use forward testing or paper trading, where they run the strategy in a simulated live market for a period of time. This confirms that the strategy works on new, unseen data before a single dollar of real capital is deployed. The mantra is test, test, and test again. Preparation is everything. So, where is all this heading? Let me tell you, we're not at the end of this revolution, we're at the very beginning. The future of trading is being written right now in lines of code and mathematical formulas. The trends we're seeing today, more data, smarter AI, and faster execution, are only going to accelerate. The days of traders yelling in a crowded pit are a distant memory. The future belongs to the quants, the data scientists, and the machines they build. Get on the train, or you're going to be left at the station. This is not a drill. Artificial intelligence will become even more dominant. The AI of today is already light years ahead of where we were a decade ago, but the next generation will be even more powerful. We're talking about AI that can write its own trading strategies from scratch, adapting to new market regimes in real time without human intervention. These systems will process not just market data and news, but video feeds, satellite imagery, and even government policy drafts to generate insights. The predictive power will be staggering. It's a new arms race, and the weapon is superior intelligence. This quant approach is not just for stocks, it works everywhere. The same principles of data analysis, strategy development, and risk management are being applied with huge success across all asset classes. In the Forex market, algorithms trade currency pairs based on interest rate differentials and macroeconomic news. In commodities, they predict the price of oil and corn based on supply chain data and weather patterns. And yes, even in the wild west of cryptocurrencies, quants are using sophisticated models to trade Bitcoin and Ethereum, taming the volatility with disciplined, algorithmic execution. The mathematical principles are universal. And let's talk about speed. High-frequency trading, or AHFT, is a specialized type of quant trading, where the game is won in microseconds. That's millionths of a second. These firms place their computer servers right next to the stock exchange's servers to minimize the travel time of data. Their algorithms are designed to exploit tiny, fleeting price discrepancies, making thousands of trades per second for minuscule profits that add up to a fortune. While not every quant is an HFT trader, the relentless pursuit of speed and accuracy is a theme that runs through the entire industry. In this game, every nanosecond counts. The future is fast, it's smart, and it's already here. Booyah!